Welcome to the Real Estate Show. It is Monday. Good to have you here. And today we are going to be covering one of the most beautiful things in the world of real estate, which is the topic of syndication. And so if you're somebody who's looking to expand their portfolio, raise more money, deploy more efficiently, this is definitely for you. If you're somebody who's looking to invest passively in real estate, this is certainly for you because you have to understand on how these functions and structures work. And if you're somebody who's just starting out with investing in real estate and you're just getting going, it's really, really important you understand how all the different structures work and when you apply them. Because when I first started in real estate, I started off as a real estate agent, real estate broker. I was selling the houses. I didn't understand the business of owning real estate, on how to build a portfolio. Then I got into single family home investing, but then I didn't understand the business of, actually scaling a real estate portfolio and how it's actually done. I thought that, the way you invest in real estate is you save up your money, you buy one rental property, you wait and wait and wait, and then you refinance that property, and then you buy your next one, and slowly, ever so surely, you end up scaling your portfolio, and maybe you end up with 6 properties, something like that, and then you pay them off. That's how I thought real estate operated. I just didn't know there was a totally different level to money in real estate besides what most people think of when they think of real estate investing. Because we just have to look at Wall Street, right? Wall Street does one thing really, really well. They raise a shit ton of money and they deploy it. And the same thing happens in real estate. I just didn't understand how many of trillions and trillions of dollars are out there looking for a real estate deal to land it. Now, those trillions and trillions of dollars are not necessarily looking at a single family home deal, but they are looking at a large commercial deal. So, it could be a build to rent community where you're talking about 100, 200, 300 individual homes, but packaged together, and that operates like a multifamily deal. Maybe it's an apartment building, maybe it's an office building, maybe it's a strip mall. These are the types of deals that the money's really looking for. So when we talk about the topic of syndication, this is, well, how do we efficiently raise a large amount of money and then deploy it in a deal? And how do we structure that? What does that look like? And then that's exactly what I'm going to be breaking down for you, right? So like I said, Wall Street basically invented this, and well, I should say perfected it. And syndication is just a beautiful structure and a great way to raise a lot of money. And we actually have to go back to the Empire State Building way back when, and that was a form of syndication when that building was purchased. But I digress. That's a bit of a history lesson. So syndication. What is a syndication? How does it work? So a syndication is really a structure through which or in which different parties come together to own a piece of real estate. So I'll just run through the different ways you can do this. So you could, option number one, if you want to buy a piece of real estate, you could buy it yourself, right? You get the loan, you get the equity you need, the down payment, and you buy it yourself and you own it. Great. That's one way to do it. The second way is you could do like a joint venture type of partnership. And you see this a lot with fix and flips, right? Let's say you're buying something, flipping it around. And generally speaking, no, not always, you'll have 50% person. And this is generally the money person. So they're financing it. They're giving the down payment needed. And then the other 50% person, oh, I just deleted that. The other 50% person is going to be swinging the hammer, doing the labor. That's generally how these things work. Now, in this type of deal, everybody's active and everybody has the same amount of risk. So if something goes wrong, even though this person is doing the financing, they are on the hook, right? Everybody's an active party. And then we've got, let's say number 3, there's a real estate fund structure, and I'm going to cover that in a different video. That's not the topic for today. So you could invest through a fund. The fund would buy a number of properties, sell, it's got a life of its own. And then number 4 is syndication. Now, the great thing about syndication is it allows people who necessarily are not active in the deal Maybe they're a doctor, maybe they're a lawyer, maybe they're a programmer, a business owner, and they want all the benefits of owning real estate. They want the appreciation, they want the stability, they want the cash flow, they want the tax benefits, but they're not real estate experts, right? They're busy doing what they do best day to day. They're making a high income and they want to invest it somewhere. Their mutual fund isn't so hot, and they want to own real estate. They just don't want to get into being their own landlord. Like I used to be, like, when the tenant calls at 10 o'clock at night and then you got to go deal with it. That's not what they want to do. That's not what I wanted to do either. They want to get away from that, but they want to enjoy the benefits of real estate. And this is exactly where syndication comes in. Because what syndication is going to do is it's going to take a bunch of people who on their own. So let's say we have, this is our deal right now. Let's call it a 100-unit deal. 100 units right here. On their own, this person, this investor, let's call them a doctor, right? This doctor wouldn't be able to own this deal and operate this deal on their own. Why? They probably don't have enough money. Maybe they don't have $10 million in equity in cash that they can put down on this property. Maybe they don't have the track record. Maybe they don't have the market knowledge. Maybe they don't have the team. Maybe they don't know how to make money in this type of deal. They want to invest in this deal because of all the benefits, the cash flow, appreciation, tax, all of that, but they just don't know how to do it. So what syndication is going to do is this going to take a bunch of individual investors like this. So maybe each individual investor has $200,000 each, right? Let's call it $200K each. On their own, like you need $10 million, then you have to qualify for the loan, all that type of stuff. They don't have that. But when we pool these passive investors together and everybody brings their 200K, now we've pooled together $10 million. Now we've got sufficient mass of money that now we can go into the market and make a dent. But here's the problem. Doctors, lawyers, programmers, business owners, accountants, they don't have the real estate know-how, right? They might know in theory about how it works, but they're not the boots on the ground. They're not the ones making it happen. So we need another group of people who actually can take the money and put it to work. So on this side, the passive investors, it's called the LP, the limited partnership. I'll get to that in a little bit. Now we're going to create a second group of people and call it the GP, the general partnership. Now, the general partner, it can be a single person, a single company, a group of companies. It's just a name, right? Depending on how, the makeup. But let's say it's our company, right? CPI Capital. We specialize in acquiring underperforming apartment buildings, and we'll bring our investors in and we'll do the deal. That's what we do. Like we just closed 136 units. I think it was like 4 weeks ago, something like that, right? That's what we do. We are a GP because we know the market, right? We have the connections. We have the deal flow. People send us deals, right? We're able to analyze and underwrite the deals and manage the deals. We've got experience in that. We know what to do. We know, hey, we see this deal. We know exactly how we're going to make money because of this and this and this, right? Because we've done it before. Or, hey, like we're looking at this new market. This is exactly what we look for in a market. This is how we know it's the right market for us. We know these are the signs we're looking for. We know how to manage the deal. Hey, okay, well, maybe in year 3, we're seeing these factors and maybe it's time for refinance at that point. We know what we're doing, right? So we're the GP, we're the pros. So I'll just write pros here. Right. So now what happens is you've got this group over here called the LP, the limited partnership. These are all the passive investors. And then you've got the GPs over here, the pros. And when we're looking at what makes a real estate deal work, I use something called the real estate matrix. The 4 things, the 4 components every single real estate deal must have. So number 1, you must have the deal, the opportunity itself. Then you need the equity or the money to make it happen. Then you need financing, so the debt from the bank, a lender, and then you need management. And I just don't mean property management. I mean, hey, who's going to make all the key decisions in the deal? How are we running this? How are you turning this deal around? That's what I mean by management. So the pros over here, the GP, the pros bring the deal, they bring the management and the financing. The only thing that's missing in this equation is the equity. Now, in our case, we bring equity into the deal as well, but the majority of the equity is going to come from our investors. And this is where the LP comes in, because the LP is made up of investors who want to place their capital in the deal. They want to be passive. They want to invest their money and get a check every single month, right? And they want to get the updates, but they want somebody else doing the work. That's our business, right? And this is how syndication can help you, right? Because if we're raising $10 million, sure, in theory, you could go out and find one investor with 10 million, maybe a small family office. They write you a $10 million check and you do a joint venture. Totally fine, right? And we have investors that come in with large amounts of money. But there's a lot of capital out there from what's called retail investors. So regular people with 100, 200, 300, 500, $1 million that they want to invest, they just don't have the know-how. So they're going to seek out opportunities through syndication where, hey, I have all this money, I'm going to pool it with other investors, and together the general partner is going to then go and do the deal. So they're going to deploy it. So the general partner is going to have the business plan, they're going to know the market, they're going to have found the opportunity, they have the support. All they need is $10 million, let's call it. So now they're going to go to investors at $100,000 a pop, right? So that's 100 investors, or at $200K a pop, that's 50 investors. So 50 investors will come in together, and then they'll invest passively into the syndication, into the deal. Now, how is this different from that joint venture where I said everybody's active? Well, the beautiful thing about the syndication structure is that there are protections afforded because of the way the syndication is set up. So the limited partnership, the LPs, the individual investors, they're not real estate experts, right? They're not swinging hammers. They're not hands-on. So the risk is limited. The liability is limited. And that's why it's called a limited partner, a limited partnership, because the risk is limited on that end. So if something goes wrong, right, the general partner is shouldering all of that risk and liability. The limited partnership, what they're risking is their capital. So just like somebody buying a stock or any type of other investment, you're risking that investment in the marketplace. So if you buy a stock in IBM, and all of a sudden the company crashes, and now that stock could go from being worth whatever to zero. That could happen. That's a risk. Just like in any real estate deal, in theory, even though it's very unlikely, but in theory, the property could go from being worth 20 million bucks to zero. In theory, it could. Very unlikely, but it could. So you're risking that capital. So that's what's being risked there. But the underlying, or not underlying, but the other types of risks. So the liability, the guaranteeing the loan, being liable for, like something blowing up. That's the general partnership. The general partnership is shouldering all of that. The limited partnership is protected. And this is why investors really enjoy and like investing through syndications, because they get the passive income, they get the stability, they get the appreciation, but not the risk, right? Because when we look at real estate deals, risk plays into it. And I feel that sometimes that risk isn't talked about enough. Because some people, especially newer investors, they'll get fixated on the potential returns, but an experienced investor will weigh and balance that compared to the risk. And oftentimes, a more experienced investor will take a less risky investment with less perceived risk and take a lesser return, but they're not. But the level of risk and exposure they have is a lot more limited, right? So that's a topic for another day. So with syndications, so let's say we're raising $10 million here, $10 million bucks through, and everybody's at 200K a pop. So we've got 50 investors. So the general partner will get 50 investors together, create the limited partnership, and then the general partnership here will run the deal. They're making all of the decisions. Now, how does this actually work? Well, it's done through shares. So what's going to happen is there's going to be different classes of shares in the investment opportunity, in the structure, right? So you're probably, and everybody's a little bit different, but generally speaking, you got Class A shares, and these are the voting shares. right? So these voting shares are going to be controlled by the general partnership. This is how they make decisions in the deal. Then you got Class B shares. We won't cover Class B today. And Class B shares, these are pretty cool shares. Like you can, if somebody's rolling a property into the syndication, you can get really creative with B class shares. And then Class C shares, this is going to be what the LPs are going to get. So no voting rights. And there's something called a capital stack. So if I go over here, so the capital stack looks like this. Now on the bottom, you're going to have the debt. So the debt pays a fixed rate in exchange for using the money. So this is where you go to the bank, you get debt, whatever. This is the debt down here. Now up at the top, we have equity. So we have common equity at the top, and this is generally going to be the GP. And then down here, we have preferred equity, and that's going to be the LP. Now, not to get too complicated, sometimes everything's common, but I don't want to get into that. But generally speaking, what happens and why this is important is the LP is lower than the GP in the capital stack. So that means they get paid sooner or earlier than the GP. So if something goes wrong and money runs out, the last person at the top of the totem pole is the GP. They get paid last. So the limited partnership enjoys some protections here as well because they're before the GP on the capital stack. Okay. So now what's going to happen is the general partner, they're going to find the deal. And let me just walk you through it. So they're going to find the deal. They're going to underwrite the deal, make sure it's a good deal. Now they're going to market it, or they're going to take it to their investor database and say, hey, Mr. and Mrs. Investor, I've got this deal coming up. This is what it looks like. These are the numbers. These are the targets we think we can hit with it. This is why we think it's a great deal. Great. Okay. So this is usually it's done with a webinar or some type of call, an investor call, walking them through the deal. And there's going to be collateral and marketing packages like decks, all that type of stuff. What happens then is there's going to be a PPM or OM prepared, and this is the legalese. This is the legal document that the lawyer is going to draft up, and it's basically saying, hey, this is everything that can go wrong in this deal. This is our plan for this deal. These are all the rules for the deal. This is what the deal looks like. This is how money is going to get paid out. That's the OM PPM. So the investor is going to look at that, and then they're going to sign a subscription agreement. And this is where the investor is saying, hey, listen, I want to buy X number of shares in this opportunity for X amount of dollars, right? Hey, I want to invest X amount in this deal, but you sign the subscription agreement, and then you have funding, which is where the investor will wire the money into the bank account, and then the closing date happens, and then the business plan gets put into place, and now the real work starts because now the property is owned. That's the timeline of a syndication, right? So we're owning the property. You've owned it for a little bit. There's money flowing. How do people get paid in the syndication? Now, this is a very common question, and depending on the person, it could be monthly payments. It could be quarterly payments. It really depends. But generally speaking, you have two different ways of getting paid. And I liken this to cookie crumbs and a cake, right? I enjoy eating. So you got cookie crumbs here. Then you got a cake. So the cookie crumbs, and this is supposed to be candles. So the cookie crumbs are your monthly or quarterly distribution payments. So, hey, the property made X amount. We have to hold so much back in reserve. So you're going to get a check every single quarter, every single month. Here we go. Boom, 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 boom. And then whenever you have what's called a capital event. So this is where somebody is going to refinance the property or they sell the property. This is when you make the big bucks, right? So you're basically getting cookie crumbs, cookie crumbs, cookie crumbs. That's from the cash flow. Capital event happens, refinance or a sale. Boom, this is where you get the big check. This is how real estate deals work. Now, how these get paid out is paid out through what's called a split. So this is basically saying, hey, how are these profits split up between the pros, the general partnership, and the passive investors, the LP? Okay, so there's no standard, and it's going to vary depending on the risk in the deal and a whole bunch of other factors. But I'm just going to use an example. So let's say the split is 70-30. And this is usually how you will see it expressed. So if you see a 70-30 split, this means that the general partnership is going to be entitled to 30% of the profits, and the LP, the limited partnership, will be entitled to 70%, right? If you've seen 80-20, a 60-40, 75-25, it's all the same thing. So it's going to be in favor of the LP. So 70% of the profits go to the LP, 30% go to the GP, 80-20, you name it, okay? So this is the basic way to do it. Now, there's going to be something called hurdles and waterfalls. So basically what happens here is that the general partner is going to say, hey, listen, until we get the deal to this point, right? This is our standard. This is going to be the split. Now, not every GP has a split. Like there's nuances. Sometimes it's still dependent. You want to ask these questions if you're looking at a passive investment opportunity, right? You want to understand the deal. But what's going to happen is if there is a waterfall or a hurdle, the GP is going to say, hey, listen, maybe it's going to be a 70-30 split up until we get you X amount return. Maybe it's 12%, right? 12% return. Okay. After that, now the split will change because we've hit that first block. So maybe it's 70-30 to here. Once we've hit the ceiling, right? Once we've hit this hurdle, now to get us to the next one, maybe it's a 60-40 split, right? Because at this point, the general partner, the pros, they've actually performed better than they thought they would. They've actually done extra. So now you want to reward the general partner to keep it going, right? And money talks. And then after this, maybe you hit this target for X percent, and maybe it goes to a 50-50 split. Because from the LP side, the limited partnership side, you want to make sure that there's an alignment of interest where the general partner is incentivized to make the deal make a lot of money, right? And the way you do that is as from the LP perspective, okay, well, we'll have this split, but if you outperform, if you start doing better than you think you will, hey, I want to further incentivize you to keep the money train rolling, right? To keep the gravy train going. And I want to make sure that you're hungry to get to that point. So maybe standard for this deal was X amount, whatever percentage it is. This is where they think they can do. And the LPs should want to have some type of hurdle or waterfall. Say, hey, listen, like if you can make the deal do better than this, because I'm happy here with this percentage, I'm happy. But if you can do better, hey, like I want to make sure you're incentivized. We're going to have a different split for you at this point because I want to make sure you're hungry for this. Perfect, right? Because now the GP money talks, and there's things called preferred returns. We'll get into that on other episodes. But you can really incentivize the general partner to make sure that number one, they're making money if the deal makes money. So they're not really making money if the deal's not performing well. That's one way to get this figured out. But then also, you want to make sure that that incentivization, those incentives are there in terms of structuring, just to make sure like the LP is looked after and the GP as well. Okay, so that's how splits work in a syndication. Because at the end of the day, just remember, we're combining two different groups of people, right? We've got the LP on the one side. Right, LP is over here. The GP is over here. We got passive investors on this side with the money. We got GP, the pros over here with the experience and the expertise. Right, we're combining the two. And this is where the PPM, the offering documents, will lay out exactly how this relationship is going to function. So if you're coming at it from a GP side, if you're looking to scale the amount of capital you can raise efficiently, syndication is a great way to do it. And you're going to want to design and create your offering memorandum, your OM, your PPM. You're going to want to create and craft it so it's investor friendly. So investors will be attracted to it and it makes sense. From an LP perspective, when you're looking at a syndication, you want to look at the terms and make sure they make sense for you. Are the incentive structures in place to make sure the GP is really pressured to perform well? Yes. Are the fees excessive? Yes or no? Is the GP making money strictly based on fees rather than splits? If that's the case, alignment might not be there because the GP is going to make money no matter what, because fees are always paid. is not performance dependent. So there's all of these types of things that go into this that you want to look at. So from the GP perspective, hey, how do I create a deal that's investor friendly? From an LP perspective, hey, do the fees make sense? Do I understand the business plan? Can I see this making money? Is it just fairy dust, or is this grounded in reality? Those types of questions you want to bring up. But together, you can bring these two parties together, do the deal, and then the deal's going to run, whether you hold it for 3 years, 5 years, 10 years, whatever it is. Now the GP can run the deal. The investors are getting their checks. Everybody's happy. That's how syndication works. And at the end of the day, syndication is ideal for raising a large amount of money and deploying it, because like you can tweak this, you can really customize it, you can get as simple or as complex as you want with syndication. And that's the beautiful thing about the structure. And you can do a lot with it. All right. So that is syndication in a nutshell. So I hope to see you guys tomorrow for the bullpen, where we take you behind the scenes. We talk about the sales team's process. That's a lot of fun. I'm actually going to be sharing a story from an experience I had on Friday with a sales team, and a lot where we can like unpack where things broke down. All right, so that is coming up tomorrow. But in the meantime, if you are interested in learning how to get into your first apartment building deal and learn that, go to theapartmentaccelerator.com. Right here, this is our program for investors looking to get into apartment building investor. All right, I will see you guys on Tuesday. I will see you then. Happy investing until then.